Hi, I'm Alec with Lending Mac TV, and in today's episode, we'll talk about the 3 best lenders for unsecured debt consolidation loans. Let's get this straight right now. You can't borrow your way out of debt. But unsecured debt consolidation loans can put you in a financial position to make the most of the incoming money that you have right now. To illustrate our point, imagine that you're sitting in a small sinking boat. Plugging the holes in that boat won't get you to shore, but plugging those holes does give you the opportunity to get back to dry land and to safety. In the same sense, consolidating your debt gives you an opportunity for a better future. Consolidating all of your high-interest loans into one well-thought-out debt consolidation loan at a very good rate could save you tons on the amount of interest that you're charged on your debts month after month. When it's time to write checks for your debt, you'll write smaller dollar figures. Well, that's always a good thing, right? So that's one reason why the Lending Mac continues to inform you about P2P lending and teaches you what it's all about. You need to know that good debt consolidation loans should always have a fixed interest rate, and your loan principal should go down as you continue to make your loan payments. And that's the way to stop your high-interest credit card debt from spiraling out of control. The major P2P lenders also offer online electronic payment systems that help you manage your entire consolidation loans directly and with ease. So what is debt consolidation? Debt consolidation is exactly what it sounds like. When you consolidate your outstanding debts, you're taking on a new, bigger loan in order to pay off a lot of existing debts. Here's the major advantage debt consolidation loans have. Instead of writing checks to a bunch of different creditors, you'll pay a single bill for your debt consolidation loan. Unlike debt settlement, you don't actually lower the loan principal amount that you owe. You'll still be paying out the full amount of your debt. Now, don't be blind. Debt consolidation loans are not without risks. Finance experts advise debtors to thoroughly study consolidation loan options before making a decision. Some people are even better off avoiding consolidation loans unless they're legitimately struggling to make the bare minimum payments on debts each month and are honestly ready to turn over a new leaf with their spending habits. It makes no sense to patch up holes in the boat when you're going to poke even more holes later on. Here are your pros and cons of the unsecured debt consolidation. Short-term relief. One unsecured debt consolidation loan at a lower interest rate, spread out over a longer term, can greatly cut the amount of money that you have to pay out every month. It's easier to stay organized because it's difficult to keep track of a ton of different bills and their different monthly due dates. This leads to more late and/or missed bill payments, but it's much easier to remember the date of a single bill. No damage to your credit score. Unsecured debt consolidation loans keeps your credit intact since you're continuing to pay off all of your debts. This is not as likely to happen with a debt management plan or debt settlement or a bankruptcy settlement. Long-term plan. Your lower monthly loan payment is usually the result of a longer payment term agreement, not simply the result of lower interest rates. In all actuality, instead of paying a lot of money out over a short time span, you'll be paying out a smaller amount of money over a longer period of time. And here's the catch. If you're not taking advantage of a low-rate P2P debt consolidation loan, you may end up paying out of much more in interest over the long term of your loan. That's not the perfect answer to your financial problem. Big risks depending on your new loan. If you use a secured loan to consolidate your debts, the collateral associated with that loan, for instance your home, will be at risk if you don't make your loan payments. Falling behind on unsecured loan isn't as immediately harmful because you won't lose your property or belongings to the lender, but it could still greatly damage your credit score and future financial opportunities. It's important to pay what you owe and keep a good name. You're fighting debt with debt. While debt consolidation often works out well for the fiscally disciplined, bad spending habits might be the reason you're considering an unsecured debt consolidation loan in the first place. If you don't change your financial habits, you're very likely to end up much deeper in debt than you were before you took out a debt consolidation loan. Unsecured debt consolidation is a means of packaging multiple debts together in a way that makes them easier to pay off. Unsecured debts are personal debts for which there is no physical collateral, like your home or car. Medical debts and credit card debts are two popular examples of such debt. Borrowers that are willing to do a bit of research will find many reputable debt consolidation companies and several different approaches to handling debt issues. Common approaches to handling unsecured debt consolidation fall into two broad categories. Debt consolidation loans. With this approach to unsecured debt consolidation, you borrow money from your bank or a debt consolidation firm and use that money to pay off your credit bills. Consumers need to use caution with this approach. Why? Because loans for debt consolidation can often come with high fees, costs, and risks. I mean, think about it. If you're in serious debt, it'll be difficult to get respectable loan terms for a debt consolidation loan. And if you do get a loan to pay off your high interest charge cards, you'll likely face the temptation to run up your credit cards again, in which case you'll need to pay off the new balances on the credit cards on top of making regular payments on your debt consolidation loan. Debt management programs. This is normally associated with nonprofit debt relief agencies. A debt management program is a method of unsecured debt consolidation that doesn't require the borrower to borrow more cash. The borrower makes monthly payments to the debt relief agency, and the agency in turn makes monthly payments to the consumer's creditors. Another tactic, debt settlement, is sometimes confused with debt consolidation, but is actually very different. With a debt settlement solution, a settlement company tries to negotiate with a consumer's creditors to get them to accept a payoff amount that's less than what is actually owed. Creditors can and often do refuse to participate in such debt settlements, and these settlements can often be very damaging to a debtor's credit score rating with serious tax implications, even on the debt amounts that was forgiven. Unsecured debt consolidation loans don't work for everybody. But you know yourself and your situation better than anyone. If you're making minimum monthly payments on big credit card debt, chances are that you're most likely paying too much interest and not paying down the actual principal by much. This is a trap that too many Americans find themselves in. Now, paying monthly on credit card bills like this won't make much of a dent in your overall debt. And if you happen to miss one or two payments or exceed your limit, your credit card interest rates will shoot up even higher. The smart move may be to replace your credit card debt with a peer-to-peer unsecured debt consolidation loan, where your interest rate won't change and your loan principal can be effectively paid down and eliminated as you make fixed monthly payments. Alright, that's it for this episode of Lending Mag TV, so thanks for watching. And if you'd like to know more about getting the right lender, check out the description below for links to more insight that can help you to figure out which one is the right one for you. You can also apply for loans or apply to invest in peer-to-peer investing. Also, if you want to learn more, we recommend you subscribe to our channel to receive more updates and news on the lending market. All the best, and be sure to like and subscribe for more.